Bloomberg reports that Kevin Hassett has emerged as the frontrunner to be the next Fed chair to replace Jay Powell. Joining me now is Stephanie Roth, Wolfe Research Chief Economist. Stephanie, it's good to see you. You, like all of us, you're thinking about 2026. You're trying to figure out what the picture is going to look like here. And you guys are looking for kind of trend growth, if I'm not mistaken, in terms of GDP for 2026. So how do you think that's going to play out?
Yeah, so I mean, it should be a decent year. This year it's been slightly below trend. We should see a bit of a pickup, specifically heading into tax season, which is where you'll see some consumer benefits, which should help specifically the sort of mid to lower end consumer. So there should be a benefit there. Now, it's not going to be a very robust year, but it should be fairly decent, which is one where the Fed's likely to cut in December, and then they're probably going to be on hold for a little while because growth will be picking up. Inflation will be a bit elevated in Q1. So then we're talking about potential cuts kind of after the next Fed chair, once perhaps it's Hassett. Once he gets into position, then we're talking about potentially 2 more cuts. But it should be a decent year. Inflation should be decelerating, and consumers should be looking a little bit better than they've been.
Stephanie, how much of the gains in economic growth right now and then headed into next year is sort of related to AI, the spending on AI, what companies are doing around AI? How do we sort of quantify that?
Yeah, so we've looked at sort of the AI components within GDP, and our estimates suggest that it's currently on a level basis, the actual size of AI spending related to CapEx is about 1.5% of GDP. That compares to larger investment bubbles, which are 3.5 to 4.5% of GDP. So we're certainly not in bubble territory in terms of the level of investment. As for how much it's been contributing to the economy, our sense is it's boosted. It's kind of representing about a quarter of the GDP growth that we're seeing. So certainly important. Not necessarily game-changing. You hear estimates out there that suggest it's about half of GDP growth. We don't think that's the case, certainly smaller than that, but also a fairly substantial portion of the growth that we've been seeing.
So even if it's not, huge, but it's still substantial, we talk a lot about how dependent the stock market is on the AI trade. We've talked less about how dependent the economy is on the AI trade. And so I wonder if you share any of the concerns out there about overinvestment and whether the AI part of the economy is a risk at the margin if it slows down.
Yeah, at the margin, it is a risk. Certainly if it slows down, because it has been an important driver of growth, if not the primary driver. However, it doesn't appear to be sort of in bubble or frothy territory. Of course, now we're starting to get to the phase where we're shifting more towards debt-financed growth as opposed to it being mostly coming from cash flow. So, of course, that becomes incrementally more risky. But as of now, it doesn't appear to be something that we should be overly concerned about. The CapEx is likely to be fairly strong for 2026. Companies need to kind of race to the investment cycle. They don't want to be left behind. We don't really know the real benefits of AI from an economic perspective. That will take a lot longer to play out. So up until then, companies are going to just continue to invest until perhaps we realize they've invested too much, and then it might be at risk of bubble territory, but we are a ways away from that.
And Stephanie, let's talk a little bit more about the Federal Reserve and especially the outlook for leadership at the Federal Reserve. If it indeed is Kevin Hassett, or really even if it's anyone who this administration is going to nominate, presumably it'll be somebody who is more dovish here. Do you think is that sort of the base case here, and what does that mean for Fed policy?
Yeah, I mean, remember that it is a vote by committee. So our expectation is even if the chair is a little bit more dovish in nature, they will have to get everybody on board. And, that might be a little bit more difficult to do, especially in an environment where inflation is still remaining elevated and rates are closer to what FOMC members view as neutral. So now it's a little bit of an easy argument come for the December meeting because many Fed members believe that we're still in restrictive territory. But once you get closer to, call it, 3.25%, 3.5%, 3.75%, a lot of, the decision is a lot more difficult with each additional cut. So it will be more difficult for them to sort of jam more dovish policy through. So our expectation is they'll probably get another 2 cuts or so, and then that will probably be it.
Do you think that there are still concerns around credibility at the Fed, especially if it ends up being Hassett?
maybe at the margin. I think, certainly those fears have died down to some extent, which is, of course, really positive. We were really concerned when Fed independence was being questioned. I think what we've seen since the Cook case came out is the Fed members have kind of come together. So specifically Bowman and Waller, they all kind of voted with the rest of the committee rather than dissenting, which would have been a signal that perhaps the Fed is fraying at the margin. But now it seems that the other members have been coming together. So I think it is a concern that's lingering, but it's certainly not as severe as what was earlier the case. So it seems that the risk of, say, in February, when they have to renominate the regional Fed presidents, that the members will largely get on board rather than some sort of negative event where they have trouble getting through the regional Fed presidents.
Right. And Stephanie, I do want to ask you about the labor market, the job growth backdrop here. I'm encouraged to see your estimates that you're still looking for growth in jobs next year, not declines. And what do you think is going to sort of support that job growth?
Yeah, so our view is that you'll see a bit of a pickup, and specifically in the cyclical areas of the economy. So retail, finance, leisure, manufacturing could get a little bit better. So the areas that have gotten hurt this year, largely because of economic uncertainty and the slowdown that we've seen this year, if we just see a bottoming in growth and activity picking up a bit, our assumptions are that you'll see a pickup in a lot of those areas of hiring as well. So we're looking for job growth to average around 80,000 for 2026. That compares to the recent average that's closer to 70,000, if not 60,000 if you shorten the window. So our assumptions are that you'll see just a bit of a better hiring backdrop kind of across the board. This year you've gotten a big slowdown, partially because of immigration, partially because of AI, and then the big reason and the most important reason has just been the broad economic slowdown. And those headwinds will turn to marginal tailwinds next year.
The long-awaited September jobs report came in much stronger than expected. Payrolls rose by 119,000 a month, though the unemployment rate ticked up to 4.4%. Yahoo Finance Fed correspondent Jennifer Schonberger sat down with Kevin Hassett, the director of the National Economic Council. He reacted to that jobs report, affordability challenges, and the possibility of being named Fed chair.
I think that if we look at the payroll side, that's correct, that there was outsized growth in education and healthcare workers. Sometimes we see that around September because of seasonals with people coming back to school. But it is true that there's been a sectoral increase over time of demand for healthcare workers. And I think that that's a trend that will likely continue. The thing that jumped out at me that I thought was very interesting in the report was a big surge in construction employment. One of the things that was a high priority for us when we passed the big beautiful bill was expensing factory construction, and so the fact that we're beginning to see people breaking ground on all those new factories that we expect to come up over the next year or two is a really positive sign for the outlook going forward. I think if you look at GDP now, it's running at 4.2% now for the third quarter, and it was about 4% in the second quarter. So that you could say that coming into the government shutdown, this jobs report shows us that it was full steam ahead, this economy, about as good as economy gets. On the unemployment, I think that there are sort of two times as an economist when you look at the unemployment rate where you have to decide what you think about it. There are two ways that you can think about it. One is if labor force participation goes down and unemployment rate goes up, that's a really bad sign. Because what it means is that people are getting frustrated and they're giving up trying to find a job. If labor force participation is going up and the unemployment rate goes up, it could be that it's actually a whole bunch of people who came off the sidelines and they're looking for a job, but it's actually good news because of the labor force participation, not, of course, because of the unemployment rate. And there's a big uptick in labor force participation in this report, which suggests that, the full steam ahead economy that we've created pretty much since we passed the big beautiful bill is getting people off the sidelines and making them look for work. And so if you figure that we got construction people building factories and people cut off the sidelines and looking for work, you'd have to say it's a really strong report.
To your point, Kevin, there were some concerns that the labor market had been weakening until we got this report, putting a rate cut on the table for December. Now that we've gotten this report, looks like that's becoming less likely. What's your reading, and what would the administration's reaction be to no cut in December?
Well, I think that if we look at the news that we got before this report, and don't forget this is a September report, the news that we got between the meeting 2 meetings ago and the last meeting with the Fed, and recall that 2 meetings ago, the Fed was saying, yeah, we're going to cut 3 times. It was pretty much priced into federal funds futures markets. Well, the news that we got subsequent to that meeting, in between the last 2 meetings, was that we had a government shutdown that's going to reduce GDP growth by 1.5%. And we had a consumer price index report that was way better than expected. In fact, it was lower than 48 forecasts that were people who were surveyed at Bloomberg. And so if you've got, before this report, a whole bunch of stuff that would argue in favor of another cut, then you'd have to ask yourself, is this cut, is this in jobs report, is it large enough so it would offset that other news? And I don't think that that would be prudent. I think that the headwind for the fourth quarter is really strong. The shutdown came at just about the worst possible time. I've had airline CEOs coming in and talking to me about how disruptive the Thanksgiving holiday travel season has been, because people will be booking their flights for Thanksgiving, and a whole bunch of people decided not to go on Thanksgiving. So I don't really think that we have a full handle on how destructive this shutdown will be for fourth quarter GDP. We're super optimistic about the future, but I think it would be a very bad time for the Fed to pause.
So it sounds like you think we could see some slowdown here in the fourth quarter before a bounce back next year. I do want to ask you,
because of the government shutdown, yeah.
Yeah, I do want to ask you, though, because the president hinted on Tuesday that he may be starting to talk to Fed candidates for the next Fed chair himself. I know you are on that short list. In fact, you are the favorite right now, according to Polymarket. Have you spoken to the president about this? And if you were selected, what changes would you make if you were Fed chair?
I'm not going to talk about discussions I have with the president. That's one of those things you don't do when you're a White House advisor, regardless of what the topic is. I can say that I'm humbled to be on the list. There's a lot of great folks there. And I think that probably each and every one of them, like me, puts a high priority on Federal Reserve independence, on sound money policies, and getting interest rates aligned with the data. I think to the extent that I'm old friends with Jay Powell, to the extent that we've had disagreements, it's not because he's a bad guy. It's because I think they've made some bad policy decisions. And they've made policy decisions that look to me to be